Okay, good afternoon. It's my pleasure to welcome you to today's session, jointly run by the Walters Kluwer and CTA. The topic today is the ATO insights into cross-border financing. Before I go any further, I would like to acknowledge the traditional custodians of the land upon which we meet today, the Noongar Whadjuk people. I pay my respects to the elders past and present. My name is Mark Lewis and I'll be your facilitator this afternoon. The presenter today is Shahzeb Panhwar. He's an assistant commissioner at the ATO, and it's fair to say he's the driving force behind the recently released PCG. Shahzeb would like to keep this session as interactive as possible, so please feel free to raise questions at any time, but I'd ask you to use the roving mics for this purpose. I may also have to repeat the questions given that we have over 250 people joining our live webcast. So I also welcome those joining online, and I'll be passing on your questions on to Shahzeb. Shahzeb, it's fair to say you've got your work cut out for you today, so over to you and good luck, sir.
Thank you, Mark, and thank you everyone for joining us both live and also who are dialing in online. Firstly, I want to repeat a couple of things Mark sort of mentioned. Obviously, we're talking about finance. My intention today was probably to spend 10 minutes about getting the messages across that I wanted to get across to the audience. And then really the intention is, what I hope to get is hopefully to answer a lot of your questions in the other half. So I've got a few things that I really want to get across to the audience, both here live and across Australia. But the real intent behind this, and when Mark and I sort of sat down, we had a call to say, well, what should we do? It's really about, well, we know what's been said, but what comes next? And that's sort of what the title of this presentation is about, is, well, what do we do next? What do we need to know? How do we need to go about it? What are our options? How do we navigate the various parts that are before us? And if you do choose to do it, my job here is to let you know, well, if you choose a particular path, here's what you need to know about it. So the intention is for it to be interactive, but that kind of needs a two-way relationship. I can try to be as interactive as I can, and worst to worst, I might have to drag some people up on stage and ask them questions myself, but if you could help me out with that interactivity, I think they'll go a lot smoother. So before I go on any further, let's get into the presentation. If at any stage you have questions, either raise your hand, send them through to Mark. He's checking on the online feed, and we can go from there. So this session today, it's a little bit about myself and Mark. Starting today, what do I want to go through? There's a little bit of a assumption today that the audience members have a degree of comfort or familiarity with both the Chevron decision and the PCG itself. I don't particularly want to go into the details of either of those documents in depth as part of my presentation. That's not really what I'm here to communicate. If there's questions about the PCG that you'd like to ask me, I'm happy to answer those, but I don't want to go through a document that you've probably read through and telling my side of the story. I'd rather have know your questions and help interpret that document for you. So there's a bit of pre-knowledge sort of assumed about both Chevron and the PCG, but we'll go through a couple of the key points on both of them. Then it goes into this what next, right? What are the various options available to taxpayers, and then what do they need to know? We'll talk about transitional arrangements that are discussed in the PCG. We'll talk about this concept of the white zone. So we've got the whole rainbow of Skittles flavors in terms of the zones, but we've also got this white zone. What does that mean? How do you access it? Can you access it? And then what's the consequences if you're able to get into it? And then finally, there are taxpayers who, absolutely rightly say PCG is all well and good, but I'm pretty comfortable with my position. And so really the last sort of part of this, my presentation at least before the Q&A is, well, if you do want to defend your position, how do I let you know what our approach is going to be? How do I sort of forewarn you in terms of the approach the ATO will take so that you're able to prepare the right documentation, you're able to get the information better, so then should we come and seek to have a review that you're already comfortable with that approach, you already have that information ready, and our discussions, our dialogues at that stage can be a lot more informed, a lot more productive and efficient than what they might otherwise have been. So let's get into it. If there are any questions, as I said, let me know. So Chevron's got a lot of different components in terms of the decision and what that means. I've broken them down into two parts. The three dot points I have are what I call the practical, enduring takeaways. There are a lot of other takeaways which I consider from my perspective to be Grateful at the intellectual curiosity in terms of how to, for example, what's the role of treaties here, what's the role of particular provisions in applying it, the interaction of the two provisions. Really good if you want to know from an intellectual perspective about how the tax law works, great. In terms of what those takeaways mean going forward, probably limited. We're in a different era, different laws, so I've sort of broken down the 3 key takeaways from myself and how the office is taking it and put it up there. The first is that our transfer pricing provisions do not have there's no mandate to say that you have to divorce the relationship between the Australian entity and the rest of the group. So historically there was this debate as to, well, do you treat an Australian subsidiary and an Australian parent as a standalone entity that needs to be assessed on its own profit and loss and balance sheet, and you disregard any sort of association with any other member, or do you consider it in its actual context, which is, well, a member of a global group? From our perspective, Chevron was quite clear that there's no mandate to say, well, you divorce the relationship completely. The transfer pricing rules require you to give effect to the actual conditions of the parties, which is, well, one of them being a member of a global group, and all you need to do is the minimum required to break the relationship. So all you say is that, well, whoever I'm dealing with is not a member of my group, but that doesn't change the fact that I'm a member of a global group. So this mandate about you have to be an orphan and the way you analyse a transaction is on an orphan perspective. That's sort of for us in the past, and we take into account your relation in the global group. What that means, we'll go into a bit later when we go through some of the case studies, because it can mean different things to different taxpayers. Second is, I call it unicorns aren't easy to find. And that's where there are legacy arrangements which are around the tax world and across the related party market, which were, for all intents and purposes, conjured up in some transfer pricing or international tax advisor's basement somewhere. All of these various provisions were created to give rise to this perfect instrument, which was which satisfied all the tax rules but didn't really have any connection with what was going out in the market, right? And so we call them unicorns because they are said to exist in the hypothetical related party world, but you look for them you go out hunting for these transactions in the real world and you can't find them. So unicorns aren't easy to find, and what Chevron sort of said is that if you have one of those transactions and you're not able to support, one, the commerciality, and secondly, as a result, the pricing of it, it's really hard for you to be able to defend your position. So the further your transaction is removed from what the market's actually doing, from our perspective, the more difficult the time you will have in defending your position. Lastly, evidence as always wins the day. The importance of getting the right evidence, not only regarding the actual price. So we see a lot of analyses historically which put together evidence as to why a particular number is correct, but have no regards to, well, what are the assumptions or what are the conditions in which I base that number? Are they correct? So are the terms and conditions of my arrangement, are the terms and conditions of my instruments, are the facts and circumstances of my dealings with the related party, are they arm's length? There was no sort of regard having had to that. So one of the things which I think Chevron sort of brings to light for everyone is that at the end of the day, if you've got this transaction which has no evidence that supports commerciality, you're probably having a difficult time, one, convincing us, and then potentially even convincing a court that it's an arm's length situation which the court should respect. So those are the 3 takeaways. There are other ones which I think are interesting from an intellectual perspective, from a pure tax perspective, but I'm not sure they'll inform our discussions particularly well today. The PCG. I came here last year, and there are some familiar faces certainly, to discuss the draft PCG and what was contained. And so I'll assume that most of you guys were either familiar with the draft or had heard me present there. And now we've got this final document came out. Now there were some changes, and I wanted to highlight a few of them, some of the more material ones. There are a lot of other micro ones which go towards the usability, readability, sort of efficiency of the document. But some of the key ones are up on the board. Firstly, probably the most material one in terms of how it would impact most taxpayers is that the draft had one table, and your total score of that table went towards your overall score and which zone you would fall into. What that meant was that there were taxpayers where their related party financing arrangements were, from a pricing perspective, relatively conservative. But because they had non-pricing elements, so structuring elements, it was either a hybrid transaction, it flowed through a tax advantage jurisdiction, it wasn't from a treasury entity, non-pricing related issues. Because of those non-pricing related issues, this conservatively priced loan could have gone to the red zone. Now, I'm happy for certain arrangements to fall into the red zone. I don't back away from the fact that there are legacy arrangements which are high risk from us. I think that's just a response to there was a market practice. The Chevron decision sort of says that, well, that might not be appropriate. And some of those legacy issues, when viewed in light of Chevron, will be high risk for us. So I don't back away from that. But I don't necessarily want people who are pricing their transactions relatively conservative to worry too much about us coming in and reviewing it. There's still an element of risk, but what we've done is we bifurcated that table. So there's a separate pricing and motivational factor table. And what that does is that it puts a ceiling in terms of how high you can be rated if you are conservatively priced. So if you are within a particular band of pricing away from whatever your reference rate is, the highest you can be rated is a yellow zone. So a moderate level of risk. On the flip side, if you've got from that pricing, you can have all the bells and whistles in terms of structuring, and you still not go beyond the yellow zone because there's a recognition that potentially the overall tax benefit the risk of the tax benefit may not be particularly large, and so we don't want to prioritize it relative to transactions which have both pricing elements and structuring elements in it. So that's one of the main sort of changes. Certain criteria were relaxed. Interest coverage ratio was one of them. Some of the feedback we got during our consultation was that the interest coverage ratios that we chose were based on real world sort of commercial analyses as to what do real commercial entities have in terms of their interest coverage ratio. Some of the feedback was that, well, Australia has a thin capitalisation policy. It allows a certain level of gearing which is not necessarily tied to what you would find in most commercial relationships and enterprises. So that necessarily means that a commercial interest coverage ratio may not be easily achieved. And so what we did was we did some analyses to say, well, what happens if we take a commercial balance sheet, we gear it up to 60%, what happens to the interest coverage ratio then? And so the outcomes of that are what have flowed into our new interest coverage ratio numbers. So much more generous than the initial numbers, and we feel much more sort of accommodating for thin cap policy overall. Currency. We still view currency as a risk. We feel that there's enough in terms of the Chevron decision for currency to be a facts and circumstances question, and will be decided based on the facts and evidence available in a particular case. So we still see it as a risk. However, we accept that there are certain instances, especially when you're dealing with outbound transactions, where the risk of a transaction may not be what we necessarily care about. So there's some relaxing in terms of the currency. For example, if you are borrowing and you have sufficient free cash flow in a currency which isn't your dominant currency, then from our perspective, well, you commercially would have sufficient currency in order to pay off your debts, and therefore that's lower risk for us. Similarly, if you're an Australian entity lending outbound, you can lend in either the currency of your borrower, or you can lend in your own. From our perspective, the tax risk either way. And again, reiterating that this is a tax risk document. It's not about our view on the law. It's about how we view the tax risk of a particular transaction, or the riskiness of a transaction, and how do we prioritize that. So from our view, those arrangements would be lower risk. The tax rate of lender's jurisdiction. Now, we were getting a lot of comments about, well, what's the impact of that, and how do we sort of deal with that. We restricted it a little bit. So now if you're borrowing from either your parent entity or a group sort of treasury hub, or you're borrowing from a subsidiary which happens to be in the same jurisdiction as your parent, and there's no sort of in and out relationship with that parent, all of those are, from our perspective, low risk. So if your parent's lending to you, I don't care where it's from, what country, what their tax rate is, that's part of a parent's job. Similarly, a group treasury hub, if they're lending to you, that's part of their job, that's part of their role within your group to acquire and then allocate capital across the group. So if that's the way that they're doing it, and it so happens to be in a lower tax jurisdiction, that's fine. It's not high risk because that's the actual role of that entity. Now that treasury has to have external transactions and not just sort of internal ones, so it has to actually form a treasury function, but that's also low risk for us. Also this clarification of intention. So the draft was always intended to reflect this, but what we found during the consultation that people weren't it wasn't clear enough in terms of intention. So if you have self-assessed, so for example, if you have a legal agreement which says it's a related party loan, it's unsecured, unguaranteed, there are no covenants, there's no particular protections in relation to it, there's no term, whatever it is, it's just a standard one-page related party agreement. Now, if you've gone and self-assessed under the new provision and said, well, we don't think that's necessarily arm's length, we think maybe it should be some other conditions that we price it on. I don't want to assess your risk based on what the legal position is. I want to assess your risk based on what you've self-assessed. So if you say, well, instead of 10%, our interest rate maybe should be 6%, I don't want you to, I'm not worried about the 4% hypothetical risk because you haven't claimed a deduction on it. So if you self-assess to say, well, our conditions are different to what's on our legal agreement, that we are using arm's length conditions, I want you to assess against arm's length conditions. So for example, if you have an exotic feature in your related party agreement, but you have not included a premium in your interest rate to reflect the fact that there's an exotic feature, it's not a particular risk to us. Right, so the tax consequences of that exotic feature don't exist, and therefore I don't want you to give yourself points. Similarly, if you have a agreement that says, well, it's a subordinated agreement or a junior agreement, but you've priced it as if it's senior, again, that subordination isn't a particular concern to me because you've priced it as if it's a senior agreement. So I care about what you've actually priced it against, not what your agreement is saying. So that's a clarification which hopefully has come through a lot more clearer in the final PCG. So that's great. That's the PCG, that's the sort of all the updates I wanted to give you in terms of our perspective. Now the question is, well, what's next? What's the options available to us? So there are two groups of taxpayers. I'm hoping most of you will fall into the former, and that's that there is a willingness or there is a recognition of self-assessing against PCG. Apologies if you can't see, I'll try to step across, but the first group is they will have a look at the PCG and they'll self-assess it. Now there are two consequences of it. One is you may be in the green zone, in which case, fantastic, that's great. Don't expect me to come about do anything, and you probably don't need to do all that much yourself in terms of defending your position. So you put documentation together if you want to defend your position, but if there's a low likelihood that I'm ever coming out, that's a cost-benefit decision that you need to make yourself. But what happens if you're not? What happens if you fall into some of the other zones? Well, there are probably three options for you. The first one is, well, maybe you want to transition your arrangements. You're in a high risk zone, but you're like, well, I want to de-risk my arrangements going forward. And we have a few taxpayers who have come to us and say, well, we want to transition arrangements to a lower risk one going forward. And I'll talk about that transition arrangement and how to do that, what that means. There are some taxpayers who say, well, I see your PCG, Shaz, I see all of the criteria that I assess myself. I'm falling foul of a particular criteria or two, but I think that there are real commercial reasons as to why, in my particular circumstances, this isn't particularly high risk for me. Well, in that case, maybe something like the white zone is appropriate for you. And lastly, you might say, well, I'm amber or I'm red, I'm high risk, but you know what? I've had a look at our analyses, I've had a look at the supporting documentation. I'm pretty comfortable. And then it's a really case of, well, what do I need to tell you in order to defend your position? Then what I'm hoping is a minority is that there may be some taxpayers who don't want to have regard to the PCG and don't self-assess against it. Well, for them, it's really a case of, well, preparing documentation, preparing the evidence they need to support it, and then defending their position. So hopefully, of the three options on the right, transitioning arrangement, white zone, and defending your position, I'll give you hopefully enough information to allow you to make decisions as to, well, do we take that option? Secondly, if we take that option, what do I need to prepare? What do I need to have on hand? How do I best engage with the ATO, should you choose to do that? Transition arrangements. So we mentioned in the PCG that there's this 18-month transition zone. The first thing I want to communicate as to, well, why is that even there? And it's really an acknowledgement from myself and the ATO that I don't for a moment think that there are all that many taxpayers that sat down and said, I've got a related party loan, let me milk every single cent of interest deductions I can out of this. I wholeheartedly believe that most taxpayers had a related party loan, they looked at it and they said, you know what, I don't have the expertise or the knowledge to be able to price this arrangement myself. And so they went to their advisors. Now their advisors, in good faith, would have said, well, the ATO has limited guidance in relation to how to price related party finance arrangements. There's limited evidence in terms of globally, or limited guidance globally in terms of how to do it. But this is what the market practice is. This is what everyone seems to be doing, and there's a general market consensus that this is how arrangements are priced. And so in good faith, they've gone down that approach and they've come up with a rate. Now, it's probably likely that Chevron might say that approach isn't particularly appropriate. And so despite the fact that in good faith everyone acted to try to price an arrangement that was in front of them, your answer might be wrong. And so the transition arrangement is designed to recognize the fact that you did not go into this arrangement to try to milk deductions, but it so happens that it might be high risk and it may not be in perfect compliance with the law. The transition arrangements say, well, if that's the case and you do want to get into a lower risk arrangement, and you come to us and engage with us within an 18-month period of this PCG being finalised, that we can come to an arrangement whereby in the back years, we can use our discretion with regards to the penalties and interest to the extent the law allows, and we can come to arrangements where we can. My focus, and I want to stress this, my focus is more on the go-forward years. My job is to ensure that the risk of interest party deductions in the tax system is reduced going forward. Now, I've also got a responsibility for the back years to try to make sure we deal with those, but my main focus is going forward. Why? Because I think it's a lot more efficient for us to be able to use our time coming up with prospective arrangements and discussing how to go about going forward rather than historic audits. Having said that, I still have a responsibility in the back years and I'll do what I need to do in the back years. So if we can get to, if you can come to us and I can use my discretion in terms of penalties and interest, I can also say that that's not my focus area. So I'm happy to come to a reasonable agreement on the back years so long as the go forward years, we have a level of risk that both parties are sort of willing to accept. And what that means, what do I say reasonable arrangements? I don't necessarily need all of the arrangements to be green back years and go forward years. Depending on your arrangements and what the factors in, we might be able to agree to an arrangement in the back which may or may not be in the green zone, and then going forward, if we can be comfortable about the risk, whatever that might be, as long as we're comfortable with the risk, then we can have that arrangement. That's sort of what the transition zone is, and the benefits. The benefits is that you don't have to worry about us. You've cleared out all the back years. There are no more open years. Finance, as far as you're concerned, is a done deal. Right? You can either have if there's back years and a settlement, a deed, an APA, depending on your preference, a letter of comfort to memorialise that agreement. What I will say is that you've got letter of comfort, APA, a deed. Each of those is an escalating level of comfort provided by the Commissioner to yourselves, but correspondingly, as I'm sort of increasing the level of comfort I give you, I need a corresponding level of comfort increase in terms of what I need from you in terms of information. So as you go up the scale from letter of comfort to APA to deed, I may need a little bit more information as we take every step up. So it's not designed to be an order process. It's just I need to be able to say that I've at least done the base minimum to give that particular product. How do you access it? Well, you can't self-assess a transition arrangement. You need to engage with either myself, or if you have a dedicated relationship team, with that team, and they will then engage with us. We need to understand effectively, just in essence, what you had, what you're going to have, and how you're going to move from A to B. And if it is the case that you do have arrangements which in the back years you're not comfortable that they necessarily align all that well with the Chevron decision and overall risk, then is there a proposal, or do you have a proposal with how we would deal with those back years? And whatever that is, we would like to hear it. So effectively, what do you feel the roadmap should be? And then we enter into a discussion. Those are without prejudice discussions. I don't plan on using that information for anything else. I'll go through the way we do our risk assessment anyway, but I need people sort of willing to come in. And if I start using the information when they come in to throw them straight to audit, that's not really going to help me do my job. So we have our own risk assessment products. They work on the background anyway, and we've got our own processes, but that's not how I want to engage with taxpayers in terms of the ones who are willing to come forward and engage with me to deal with the arrangements. Any question on transitioning arrangements? Otherwise, I'm happy to have it at the end or during. Any questions coming through? Or no? I can talk forever, so unless someone interrupts me, I'll just keep sort of flowing on. So the white zone. Again, there's a green zone, blue, yellow, amber, red. So people have all seen the comments of the gamer zones or the rainbow or the ATOs, whatever. And there's a bunch of descriptions about advisors, but there are some colored zones, and then there's this concept of white zone. Now, what is it? The white zone is really a recognition that the PCG was designed for a population. So the criteria, the elements, the boundaries between X and Y, 1 point to 3 point, were designed for a population. And we have something like 3,300 taxpayers with related party financing arrangements in our system, or at least large enough to disclose it. There's probably more, but they're relatively material. So when you're designing a document for a population, especially for a relatively large one like that, probably by necessity, or it's just natural, there might be individuals within that population where that risk filter may not make the most sense. And what the white zone is that, well, if there are one or two criteria in the PCG which causes you to fall outside of low risk, and you feel like that your commercial circumstances make sense, and this is that the rating in the PCG isn't reflective of your status quo risk, the white zone may be an opportunity for you to engage with us to explain why you fall out of the lower risk zones for those particular criteria. And if we're comfortable, and again, this is not something you can self-assess either, but if we're comfortable, we can provide you with a letter that says you are entitled for to access the white zone. Now, the benefit of the white zone is that one, effectively you get green zone treatment, where we're saying, well, the level of risk of your arrangements overall is so low that we're not going to be dedicating resources to review it. It's not the green zone because you don't hit all of the status quo, but if in effect, that's one of the benefits. The second benefit is that in terms of if any of you have to prepare a reportable tax position schedule, and I imagine there are some in this room who would need to complete one. One of the questions there is, where do you rate on the PCG? You can say the white zone, as opposed to you may be amber or red because of those one or two criteria. You can put down white zone to show that your overall level of risk is lower. Now, we've already had a number of taxpayers either come to us. We've issued, I think, at least 2 letters, and mindful it's still early stages, and PCG only came out in December, so January's sort of gone because people are off on leave or finalising accounts. So in sort of the 6 weeks since then, we've had a number coming in, and we've already issued some letters to say the white zone's okay. Now, the white zone, I should stress, is not appropriate for everyone. There's a reason why we have particular filters and why we have particular criteria and why we think they're risky or not. It's not for everyone, but there may be circumstances where we're actually okay with the risk. We've given an example already in the PCG. So if you're in a construction phase, then obviously you're not having a revenue coming in, but you've got expenditure, you've got debt, you've got interest expense. So your interest coverage ratio probably isn't looking all that flash. But there's a actual commercial, and when I say commercial, it's not a contrived scenario where within the economic, I want to say economic reality, but it's probably the economic fiction of a multinational group that you've created a scenario to give a particular outcome. You're actually expending money on construction, and therefore you've got a bad interest coverage ratio. And if you explain that to us and we're comfortable, then that's what it is. If you're saying stuff like, well, for example, currency, where our view is that it is risky if it's not consistent and you're saying, well, I just don't agree. That may not be the type of thing that will necessarily work. But I have offered a number of the advisors sort of no names basis discussions on the white zone transition arrangements to get an understanding of our thoughts. And so we're going through a number of those around the country. So if you do have advisors, go to them. They may be able to get a sense of our expectation or our thoughts on some of these arrangements. Any questions on the white zone arrangement? Any coming through? No. Very good. So that's we want to engage with the ATO section. Now all of a sudden we'll step into what happens if you're not particularly keen to engage with the ATO section? The first thing I wanted to externalize or communicate across to the audience is that we have a hell of a lot of data in terms of your dealings and of taxpayer sort of behavior. So I've listed just a number of those, and these are just the first few that came to the top of my mind. So we've got your tax return data, international dealing schedule data, your country by country reporting data, ASIC filings, anything that goes through AUSTRAC. There is a whole bunch of data out there in order for us to be able to assess your related party financing risk. We've got filters that are already designed similar to the PCG, where they will take all of this data, they'll assess it through the PCG sort of lens, and it will come out with the population in terms of what is low risk, what is high risk. Why I'm telling you that is that if you're high risk and you don't choose to come with us, there's a decent size of population which are in the high risk zones, and that's generally going to be priority. So amber and red and amber, we will probably know you're in high risk. And at some stage, the idea is that we will be coming and having a discussion with you. Now, I don't want to say inevitable because there's always a question in terms of where we allocate our resources, but in terms of for taxpayers who think that we won't be able to find out that they're arranged with the high risk, all I'm sort of pointing at is that the amount of data out there to help us assess and make good decisions in terms of where we allocate our resources are certainly sufficient for us to be able to do that. And our investment in terms of data analytics and ensuring that we use the data to the maximum potential that it has, that investment has sort of skyrocketed from the last 5 years, where it's now becoming that's really driven by econometric individual people who are skilled in that area as opposed to tax people. So we can tell them, here's a framework, but now we've got sort of data scientists and people with econometrics backgrounds to run those filters for us and analyze that data. So we are getting a lot better at identifying taxpayers. Okay, so this is just an introductory slide. So what I want to go through now is there are several scenarios which I've put together, some case studies, to help you understand what our approach is should we come and review arrangements. Because I think that's a really important thing to know. Now, what I will say is the way that we understand and we review financial arrangements has changed. It's almost unrecognizable from what it was 3 years ago. So 3 years ago, we started a particular, what we call a cluster, a special resourcing and workforce that was specially dedicated to have a look at financial arrangements. That was the one I was in charge of sort of as a director and then as a assistant commissioner in charge of. The way we've changed our approach, the way we analyze it and the framework in which we analyze it has changed completely. So even if you had a review on financial arrangements, say 4 or 5 years ago, the likelihood of us asking you the exact same questions and taking that approach is changed. And I think it's important for all taxpayers to at least understand how we're going about reviewing arrangements so that if you do want to defend your position, you can at least have those answers ready. So scenario one, and apologies for those in the room in the back, I'll just read out the facts very quickly and then I'll turn back. So we've got a generic sort of profile. We've got 2 foreign companies investing into OSCO. In this one, we've got foreign company. It has this global pool of funds, which isn't particularly uncommon. where it's a mixture of equity, it's a mixture of foreign bonds, retained earnings, and a global sort of debt facility which it has available. So it's got some debt, it's got some equity, but there's this pool of funds which it uses to then allocate capital across the group. It funds OzQuo. It wants to fund its subsidiary in Australia. Now it issues equity down into Holdco, and Holdco then issues mandatory redeemable preference shares into OzCo. The redeemable preference shares are priced significantly higher than any other debt within this particular ownership group. OzCo argues that the mandatory redeemable preference shares provide them with flexibility in order for them to carry out their operations, because there's no requirement to pay a dividend or to pay the legal interest, and they have that discretion whether or not to pay. The financing arrangements, because of this premium which the mandatory redeemable preference shares are sort of priced with, and the fact that the discretion almost never gets used not to pay it, leads the OzCo to either very little profits or sustained losses over the financing arrangement's life. OzCo is geared up to the safe harbour limits for thin capitalisation purposes. So it's got historically 75% gearing, or currently 60%. So here are the facts. I just want to go through, well, how would we go about analysing this? What's the questions that we need to ask? There are some breakaway sort of questions at the end. So the underlying question we've had, or the base question we need to answer, hasn't changed in the last X number of years, right? So it's the same question we've always had to ask, which is, if OzCo were to go and raise funds from the market, how might we expect that to look like, and how might that be priced? What has changed post-Chevron, so what's changed in the last few years is, particularly the first 2 points in terms of the key takeaways of Chevron, is that this is a change for the market, not necessarily for us, because there's always our position that OzCo needs to be, in analysing the question as to what might you expect there to be in terms of related party finance arrangements, OzCo is not to be treated as an orphan, but as a member of a global group. And I'll get into what that means in a moment. The second reality post-Chevron is that the instrument that you have before you, historically you priced the instrument that was before you. Now there's this question as to, well, is there a reasonable expectation that that instrument and those terms and conditions would actually have been there? And if not, well, what might the reasonable expectation have been as to what that instrument would have looked like, and then how do we go about pricing that? So really, it's a question as well, what are the arms and conditions that should be there, and how do we go about pricing that? So that's not only the instrument itself, but it might also go to a question as to, well, is the safe harbour amount of debt arm's length? Now, before anyone gets too concerned about that statement, whenever I say an arm's length amount of debt, the transfer pricing rules will not be used to challenge the quantum of debt. So there are provisions, and I want to say this very early, there are provisions in the new transfer pricing rules, both 815A and 815B, which state or which deal with the interaction of thin capitalisation and transfer pricing, which effectively say that for the purposes of the transfer pricing rules, you come up with an arm's length interest rate based on arm's length conditions, but then you apply that interest rate to the actual amount of debt subject to thin capitalisation. So when I talk about an arm's length amount of debt going forward, don't think that we're looking to annihilate an amount of debt. The transfer pricing rules, there is a theoretical possibility that they might be able to do that. I don't think we would ever use them in that way. It would have to be thin capitalisation, maybe Part 4A or some other provision which dealt with the quantum. Transfer pricing rules will deal with the pricing. But for the purposes of coming up with that arm's length interest rate, we may consider that a arm's length capital structure should be substituted for the actual capital structure. Not always going to be the case, but in certain industries, 60%, to be honest, in most industries, 60% gearing is relatively high compared to what we see, but we'll get into that. So the question hasn't changed. What would OzCo, if it issued debt into the market, what might we expect that debt to have looked like, and how might that have been priced? I mentioned before that you have to consider OzCo as a member of a global group. Well, what does that mean in practice? And here's where I start getting a little frustrating. And the answer is, well, it depends. It depends on your group and how it goes about raising debt, how it goes about raising capital, and its borrowing policies and practices, so treasury policies and practices. And what we found is that there's a spectrum in terms of group treasury practices and policies. On the one end, and most what I call industrial corporates or non-sort of banking and sort of infrastructure type of corporates, most of them tend to be around this end of the spectrum, where the capital allocation, the way that it manages cash flow, treasury risk, treasury capital raising allocations is done through a central policy where it's highly controlled by either one group or it doesn't have to be one jurisdiction, but one group. Now they will manage all capital raising, all funding, all hedging decisions based on one cash flow and one balance sheet and P&L model for the entire group. So all decisions are made based on what the group requirements are at a particular time. So if the entire group requires more debt to be issued, they will issue it normally centrally or through one or two external sort of borrowing entities. But that decision gets made based on this treasury policy where they will manage it for the group. So very tightly controlled and very tightly managed. At the other end of the extreme, and this is probably less common, but it does happen and we do see it, is that the group manages, and it's probably more common where you've got large capital intensive assets, but not exclusively in that. And just because you have large capital intensive assets does not mean your treasury policy will say this, but we're finding it's more likely in that case where they will manage each entity on an asset by asset basis. So they have an investment in a particular large asset. They will manage the treasury requirements of that based on the assets requirement alone. So they have, often they will have investments in multiple assets, and rather than dealing with it centrally, they will deal with that on an asset by asset basis depending on what that asset needs. So there's a spectrum where you tightly controlled all decisions for the entire group versus an asset by asset or entity by entity decision. Now, these aren't things that I can create. These are the realities of your group. These are the realities of your policies and your borrowing practices. So we will have regards to, well, if the question is, what would OSCO have done if it had to go out and borrow? Well, it depends what the group would have allowed it to have done and borrow. Like if it's member of a group, it would be subject to its policies. Now, if we see an example of a policy saying you cannot do X, Y, and Z, and then a transfer pricing document that comes around and says, well, the group has done X, Y, and Z, it will cause us to ask questions. Now, could you actually have done that? Is there an actual reasonable expectation that you would have done that if your explicit stated policy, which you might even have published on your global website for your shareholders to see, say you cannot do that? I would have questions and I'd want to understand why. So I'm not concluding on anything. It's hard to, this isn't, the point of this isn't to give conclusive answers, it's to give an idea as to the thought process and how we would analyze it. So what would those policies say? Now, I'll go into a little bit later as to what we might do if we can't find those policies, don't have enough information. We have a separate scenario to do with that. So that's the first sort of step is, well, we think, for example, if the question is how does one subsidiary of a multinational, how would it have gone out and borrowed? We think, well, if there's evidence of how another subsidiary of that multinational actually went out and borrowed, if there's evidence for that, that's pretty good evidence as to how you might have borrowed, right? It's at least a basis for us to form a reasonable expectation as to what that debt might have looked like. Now, as I said before, we will have a look at questions such as tenor. Now, and I use this joke all the time, so apologies if you've already heard it, but for some reason I can never understand why. I have a look at the Australian market, I have a look at the maturity profile of the debt. It tends to be about 3 to 5 years. So mostly around 3 years and under, there's some 5 years. Occasionally you'll get 10 years and longer, but you know that's becomes like you'll see the numbers 3, 5 years and then it falls off a cliff. But then I have a look at related party financing arrangements, and for some reason I've never been able to work out why they tend to be around the 9-year, 11-month and some odd days in maturity. Right? Now of course that's for debt equity purposes and it makes sense, you've got it. But then to say, well, I've got a maturity based on tax provisions and now I'm going to price my arm's length pricing based on that. I have some problems. One of those is I've never seen a group anywhere that has 60% of its, and often it's 60%, like for safe harbor purposes. I've never seen a group that has 60% of its asset value. One, I hardly ever see it financed, or 60% of being debt. Secondly, to have the maturity risk of 60% of your assets fall on one particular day, and that being 10 years down the track. I don't know if any treasurer would actually be able to sleep with that risk. Now, what's going to happen in 10 years? What if the market collapses and you can't refinance 60% of your assets? Your business is done, right? So I question if you use that 10-year instrument necessarily to price it. Well, maybe we might have expected it to be tranched, to be maybe a combination of 1, 3, 5, maybe 10-year instruments. Is 10 years right? I don't know. Let's have a look at your circumstances. Let's have a look at how your borrowing practices and policies are. Let's see if we can find some evidence as to what that might have been. Quantum of debt. Safe harbour allows 60%. Do we necessarily think that 60% is what the arms and capital structure would have been? Maybe, maybe not. I normally find that at 60%, what if that was arms and structure? Now, this is going to corporate finance a little, but the return on debt all of a sudden becomes a lot higher than your return on equity. Now, if I'm an equity investor investing in a risky asset and the debt investors are pulling out higher returns than I am, I'm all of a sudden starting to ask why, what's going on. And if I see circumstances like that, I will ask why, what's going on. How are you still in a job where your shareholders are losing value every single day that they continue to hold on to this investment? So, it doesn't make sense overall. That's kind of the analysis that we'd have a look at. That's a base scenario. Any questions on that, or any?
There's a question.
Sure.
It's on a few slides back, but it's about the white zone, and if a taxpayer wants to access the white zone, how best do they go about it? Do they contact the authors of the PCG or that department, or their own case officer?
So if you have so the question is who's best to contact for the white zone? If you have a relationship team, so if you've already got a team that you're dealing with, or you're a top 100 taxpayer with a dedicated relationship team, it's always best to coordinate any interaction with the ATO through them, just so they know in totality what's going on. If you don't have that, then by all means, there's an email in the PCG, pgifinancing@ato.gov.au. Feel free to send it to either that, or my email is sort of known. I'll then allocate it to my team. We'll get the right resources involved, and we can come and arrange a time to discuss with you, or however you want to deal with it. But yeah, if you have a relationship team, best to go through them first, and if not, then happy for you to come to the finance team directly. So that's scenario one, a sort of base scenario. Oh, sorry, I should also mention the mandatory redeemable preference share and the argument of, flexibility is really important to us. Now, I'm not trying to be here and say I'm trying to be uncommercial, and I understand commerciality of arrangements, but what I also know is that flexibility is great depending on the cost of flexibility, right? Most organizations are commercial, they value flexibility, I get that. But if that's at the cost of significant amounts of cash and profit leaking out of the group, I actually don't see the evidence of a lot of, because flexibility would be great for a lot of industries, a lot of organizations. The actual instances where third parties have gone out and borrowed it are probably limited in the circumstances. I'm not saying they don't happen, but I'm saying that flexibility is great, but the willingness to pay significant amounts of money for that flexibility, I don't see that all that often. So I'm happy to discuss why flexibility was so important for your circumstances and for you to get me comfortable on that. But the evidence I sort of see in terms of market dealing and practices is that it does happen. I'm not saying those transactions don't happen, but what are the circumstances? When would they happen? And one thing I want to raise now is that, again, Chevron sort of says that you've got to take into account the circumstances of the parties. It's a member of group. You have to have a look at what's reasonably expected. This argument of someone, sometime, somewhere, at some place entered into this particular arrangement, and therefore it might be potentially foreseeable that I have, is probably a bit of a stretch for us at the moment. The real question for TP has always been in same or similar product, same or similar circumstances. So the fact that someone somewhere, some stage has done something, well, great for them, but is that necessarily the same circumstance that you're in? We probably dig a little bit deeper now than to say, well, it's happened in the market, therefore it might happen to you. Scenario 2, and please check me on time if I'm sort of taking too long. Same facts as scenario 1, except now the mandatory redeemable preference shares are in the currency of the foreco's reporting currency. So it's, for example, let's say it's a US dollar denominated company. It's it's a US sort of parent. It's got a US dollar reporting currency. It then lends into OzCo with the US dollar reporting. Now, OzCo is exclusively an Australian dollar business, right? It raises cash in Australian dollars. There's some arguments about, well, it helps Foreco manage its accounting sort of risk and exposures, and it's optimal for group accounting policy to be able to do that. But then all of a sudden, this foreign currency denominated interest causes a tax exposure, right? So on maturity of the mandatory redeemable preference shares, there's a crystallization of potential FX gains or losses. Now that exposure is so great that the group goes, well, I can't have a tax exposure like that. I need to enter into a internal related party derivative instrument in order to hedge it. So everything else is the same, but there's now two instruments. One is the MERBS, but it's in a different currency. It's no longer AUD. And there is a cross-currency interest rate swap which hedges that foreign currency loan back into Aussie dollars. So what does this change? Again, the question for us is again the same as what might we expect OzCo to have done? Now, first thing I say is that I don't for a moment say that foreign currency borrowings matched with a cross-currency interest rate swap are not commercial. And we have reviewed instances where we've seen that, even related party, and we go, makes sense why you did it that way. We're quite comfortable. Here's where we have the problem. And I'm just talking at a high level. If you want me to get a bit more granular, I'll do it. Is we have OzCo, who's raising Aussie dollars. Now, in most circumstances, banks, when you're lending to them, want to be comfortable that you're able to pay back whatever you're borrowing. And so they'll have a look at your currency in operation. Now, this isn't all circumstances, but generally, if they're lending to you, they want to make sure that you can repay. So they'll have a look, well, do you have the cash flow in order to repay me? Now, if you're earning a different cash flow in terms of what they're willing to lend you, then there's a little bit of risk for them. Now, they might ask you to do something with hedging or whatever, but that's generally a little bit of out of comfort. Secondly, from a borrower's perspective, I generally don't want to have to incur the cost of a hedging instrument if I don't have to. I'm happy to do it if I have to. What I don't do is, well, if I don't have to enter into multiple transactions, I want to avoid the transaction cost. I want to avoid that. Just general principle. Secondly, is that what we see third parties do is when they enter into these type of arrangements, and hedging in particular, we see them hedging what we call transaction costs or transactional hedging, where, for example, you have a Aussie dollar denominated group, let's say, any group, let's say, you can pick out a name, it needs to acquire an asset in US dollars. Right, so this asset is only available in US dollars. They have to buy it from overseas. It costs $100 million. Now, they don't have $100 million US dollars floating around. So they'll go out to the market and buy it. Now, it's for a particular transaction. And so in order to make sure that transaction doesn't cause adverse consequences for their business, they might enter into a swap to hedge it. So that's what we call transactional hedging. What this is, though, is not necessarily transactional hedging, because the reason they're hedging it is not because of the transactional costs along the way, but because of the crystallization of risk. So it's what we call translational hedging. The translation of the principal from one currency to another. We don't see a lot of evidence of third parties entering into that type of arrangement. It's quite costly. It's generally not done. It's avoided. So when people say we're hedging a tax risk and the risk of a tax exposure from a related party decision that we didn't necessarily have to have made, that causes us to ask questions. Secondly, if I have a handful of taxpayers that say we have to do it this way because it's the only way our accounting and all of our risk management things can all work. If I have a handful of taxpayers doing it in a particular way, saying it's the only way we can do it, we're the only people smart enough to be able to figure it out. But on the other hand, I have the rest of the taxpayer population doing it in a different way, and it seems to work out for them. Again, I will ask questions as to why that had to be that way. So again, the question still is, what would we reasonably expect OzCo to have done? I don't give any conclusions. I'm giving the reasons why I would have concerns or suspicions. If you do have, for example, if there's a transaction, OzCo had to buy something in US dollars and therefore borrowed US dollars and decided to hedge it, that's good financial practice and management. I'll probably be okay with that. But if you chose to create an exposure in the group and then you choose within the group to hedge it without backing it out to the market, without doing anything actually within the group to hedge it, I will want to know what that is. Scenario 3. So Forco group enters into an internal restructure. Oz Holdco is now formed to hold the interest of OzCo. The new structure better aligns to global management reporting lines. OzCo's assets are revalued and there's a large goodwill component as a result of this restructure. Oz Holdco will borrow 60% in order to acquire the shares from Holdco. So they will get 40% equity and 60% debt to do it. Now, again, here's where we stray a little bit away from transfer pricing for a moment, and we have a look at the broader tax. So it might include transfer pricing. It might include considerations of Part 4A, potentially even diverted profits tax, depending on how we go. So here, what would my concerns be? Is that we have a group, OzCo, owned by Forco, right? So 100% interests at all times. We're going through Holdco and Forco. All of a sudden, there's this internal restructure where there is no change ultimately to either the ultimate interests of the parents or to the economic reality of what's going on in Australia. So Australia's overall value add has not increased at all. What it's doing here hasn't increased. There's been this internal restructure, which as a result means that there's been a revaluation, a resetting of the cost base, and a large debt component brought into Australia in order to give effect to this transaction. So when I see a transaction, what I have a look at is, well, if this transaction if this debt was to go out to a third party, would the overall benefits, the synergistic benefits, the overall benefits to the group mean that you would be willing to pay this amount? You would allow for that cash. So again, this debt, we've got to hypothesize it's to a third party. So this cash is leaving the group. Are you getting sufficient benefits within your group in order to justify that additional amount of debt leaving? If not, if there's not enough commercial benefits within that transaction, well, what's it for? And again, I'm not trying to allude to anything or whatever, but these are the types of questions that I would ask as well. Overall, there's this transaction that's gone on. Do I understand from my perspective, and I consider myself to be at least semi-literate in commercial sort of rationale, but does it make sense to me? If I was Holdco or Forco and this debt was leaving the group, I had 100% interest in all of the economic return of OzCo. Now all of a sudden, because this restructure, a significant portion of that economic interest is now filtering out to a third party. Would I be particularly comfortable? Would I be particularly happy? Would I be looking to sack the entire boards of everyone who's made this decision? That's probably where my questioning would head. is that, well, what's the commercial benefit of this transaction? Does it outweigh the costs that the group would have incurred in order for this to happen? A lot of cases I don't see that, and I don't see the evidence that prepared at the time, and here's where I'll go back to the evidence. So if you do have this type of transaction, the rationale decision making at the time in terms of what was put before the board, why did the board say yes to it, what was the forecast information, what were the benefits, what was the cost benefit, all of that stuff, I will say that this type of transaction will get me very interested. And the only way to calm me down once I'm that interested is to have that real-time information already documented. And this is where I also look to advisors in terms of helping prepare in sort of that they understand the mode, the type of questions we have. I'm trying to help you guys understand the rationale, but in terms of the form, in terms of how that should be prepared, advisors play a really important and key role in terms of helping to communicate those decisions to us. So this is what I would call generally debt creation. So if I'm not happy with it, all of a sudden there's a transaction which creates debt into the Australian tax net, where there's no other there's no economic change other than a new amount of debt and debt interest expense as a result entering into Australia. So I would be hot to trot on this one if I saw it and there wasn't enough evidence put together in terms of how to do it. Okay, here's scenario 4. So same as scenario 1, except in scenario 1 we had the group where it's had this pooled cost of funds and there was some debt coming in from the market which sort of contributed to this group. Now all of a sudden we have a foreign pension fund. So it maybe has at most some commercial paper on issue. So it relies on, it gets regular sort of contribution from its members, but occasionally members want to withdraw sort of their benefits from it, and they will issue commercial paper in order to pay for that. But then once the next sort of wave of contributions come in, they'll pay down that commercial paper, which is really short term in nature, but there's no sort of structural debt up in the group. So there's a scenario where there's no sort of debt up in the group, there's nothing for you to trace, there's nothing for you to refer to, but all of a sudden they invest into Osco and there's a debt component into it. Now, I won't even go into the joke. So normally I say, well, clearly that should be equity. It's a joke that bombs every single time. We would not say that would be equity just because there's no debt in the end. We still have to try to give life to the provisions, and if we still have to hypothecate, unless there's again Part 4A or something else involved which says that this transaction should not be there, 99.9% of times we have to somehow give life to the fact that there is this real transaction. But what it means is that if we can't find evidence in terms of your policy within your particular group, then we probably need to expand our horizons a little bit in terms of where we look for evidence of a reasonable expectation. So we might have a look at peers of either foreign pension fund or Osco, similar groups. How do they go about raising debt? Right? If we can't find it within the peers, maybe the industry in general. Right? What's the best evidence for us in order to be able to get comfortable that there's a reasonable expectation as to what the terms and conditions of this hypothesized third-party debt would have been? Now, if we can't find it within your group, then we start relaxing our standards. And look, even at the first instance, we don't just look at your group. We'll also have regard to industry sort of your peers and participants. But if we can't find information, we keep relaxing our standards in order to try to give life to this. Now, what it means is that the example might not be perfect, but it's the best evidence that both the taxpayer and the office are able to come up with in order to be able to inform the question. Now, sometimes we can't find that evidence and we need to go to an expert. Right? And when I say an expert, I'm not talking about a transfer pricing or that type of expert, but someone who's got real experience either as a treasurer in either the parent or the Australian entity, so someone who's actually gone out and raised debt in similar circumstances, or a banker that's got experience in these particular industries as to what might we expect those to have looked like. And if they're certainly credible enough and we're comfortable, we might rely on their expertise to say, well, here's what you might expect this debt to have looked like. So again, just because you don't have a traceable debt, just because you don't have the perfect one, does not mean that the analysis ends there. it might mean that we just have to relax the criteria a little bit. Scenario 5. Same facts as scenario 1, except now the parent company is actually a private equity house. So OzCo, down the bottom, has senior debt and various tranches of subordinated debt from third parties. So this includes mezzanine debt. OzCo has borrowed as much from the market as the market is willing to give it at a price that OzCo is willing to pay. So they might be able to get more debt, but it's at such a price that even the private equity firms are like, well, like, we probably won't go into that. It's probably those really high sort of yield junk bonds that you might be able to get. But even this entity wasn't willing to go out and get that debt. So let's assume for a moment that gets them up to 50% gearing. Now they've got 10% spare in terms of from ThinkCap perspective, and so they enter into a related party transaction to top them up to ThinkCap. Now, I want to draw this out for a few reasons. First is, well, how does private equity sit within the realm of corporates? And do we see a lot of transactions which private equity enters into which are unique, and so the question is, well, can we rely on a private equity transaction to support our things? From my perspective, probably not, and I'll tell you why. I contrast private equity, so we've got corporates and we've got private equity, and I contrast them as almost the same as owner-occupiers and property flippers. So when you're, at most normal corporates, as a general rule, and there's always sort of some changes, but most corporates rely on income streams from their subsidiaries in their group to repatriate dividends so that income can then either be reallocated within the group or then paid out to their shareholders in order to provide them a return. That's most corporates. So they rely on an element of income, and so they're incentivized to reduce costs, to reduce sort of capital costs, and to ensure that their P&L is as efficient as they can to ensure that they're returning maximum shareholder value to the ultimate shareholders. Property flippers and private equity are a little bit different. Their main return is not driven by dividends or from the profit and loss statement. It's actually based on the capital appreciation or the capital growth they get from acquisition to resale. So they will come in, they'll flip, they'll renovate, they'll knock down the kitchen and bathroom, they'll put in brand new sort of kitchen and open space living room, whatever it is, and they will look to resell. And so their incentive is not so much to drive down profit and loss costs, it's to reduce capital holding requirements because they enter into multiple transactions and therefore they have strained pool of capital they can invest in, and so their incentive is to reduce capital holding costs. And so they're happy to enter into transactions which most corporates wouldn't be willing to because it reduces their capital costs, even though it might be interest rates that are far exceed what you see in normal corporates. But they know, well, we're only going to have it for maybe 1-2 years, but then we're going to sell it and we'll get our capital growth, and that far outstrips the cost that we're going to pay on the interest. And so what I'm saying is that their business strategies aren't necessarily aligned to yours. They have different incentives, different drivers to most corporates, and therefore to say, well, this private equity entity entered into this transaction, and therefore I want to say, well, that's comparable to mine, and maybe I should be able to get mezzanine debt as well. That's something which I think is a bit of a stretch from our perspective. Secondly, in this fact scenario, it's not the same as every one, but OzCo was maxed out what the market was willing to give it at the price it was willing to pay. So it could not have got any more debt from the market. Like the supply and demand curve after this particular point did not meet. But then all of a sudden there's extra 10% of debt. Now they've already sort of said that, well, we couldn't have got that from the market. So what is it? And it's a question mark. In real commercial dealings, like exclude ThinkCap, exclude related party, tax everything, that's probably equity. So if you're not willing to pay the price for debt, then your only alternative is equity. And makes sense. You've got two choices. One's not available, so you've got to fund it with the other. It's equity. But now let's put back tax and transfer pricing and related party fiction. It's debt, and we will respect its debt. But how are you going to price it? I would probably not recommend you price it along the lines of your mezzanine debt because, again, I don't want to have to use the full extent of our provisions, but sometimes you get into scenarios where the evidence says there couldn't have been anything else, and all of the scenarios point me to a particular outcome, which is that, well, this might not be what it seems. I don't particularly want to have to use the rules for that. If you were to come in relatively conservative and price even that extra amount, which arguably may not be debt, as say along the lines of the senior debt, that's a bonus, that's a free kick for the group, or something along the lines of that, I'll probably be relatively comfortable and find that low risk. But if you say, well, it's along the lines of the mezzanine debt, then yeah. Well, they wouldn't allow you to have any debt at arm's length. I'm not saying, or I'm talking about from a risk perspective. I'm not talking about the provisions, because the application of the provisions. So the question was, but a bank would not allow you to have senior debt at that level.
Well, I mean, you only have one.
You only have one senior debt, right? Absolutely. So you only have one. But what I'm saying here is that, well, evidence might show in this circumstance that you wouldn't have had any extra debt. And so senior or otherwise, it wouldn't have been there. So what's the outcome? And I'm not saying that the provisions will give the outcome I refer to. All I'm saying is from a risk perspective, what would I find higher risk versus lower risk? The provisions may apply in a way that isn't particularly optimal for a taxpayer. And yeah, well, I wouldn't want to have to see where we get to in terms of that analysis. So all I'm saying is from a risk perspective, here's what you might expect our reaction to be on a spectrum. I'm not concluding on anything in terms of these, just in terms of how our thinking might head down. Scenario 6. So the same facts as scenario 1, except OzCo is in the construction phase of a large capital intensive project. How does that change our analysis? And the answer is, again, frustratingly, it depends. It really depends on your group and your borrowing practices. Now, my general assumption is that most companies don't come and invest in their first capital intensive project in Australia. It's not the optimal place to try and enter into new ventures because we have relatively high costs for a lot of things. And so you've got capital intensive projects in other places. Australia is just another one. Maybe it is the case that the Australian expenditure is a lot more in the group, but there's at least evidence that your group has got capital intensive projects that you've had to fund in the past. The question I would ask is, well, how's your group funded capital intensive projects in the past? And it could be, there are some groups which absolutely would go down a project finance cost because they don't have the capital in order to support anything else. Other groups on the other end of the spectrum would be like, well, we've already got, we can support either going to just a bond market, or we've even got internal funds which we can provide you. Well, again, what's the evidence of your group? I don't want to be frustrating or trying to be dancing around the answer. What I'm trying to communicate is that, and it's one of the reasons why it was really difficult to go down a ruling path for finance, is that the circumstances of I could have two taxpayers which from the outside are exactly the same. But the way they manage their treasury function is completely different, and you might get completely different outcomes for them, despite the fact that on paper they look really similar. And so it's really important for you as taxpayers and advisors is to understand how your group actually goes about does it. How does your industry go about doing it? Because only once you understand that can you actually overlay, once you understand the commerciality of your group, can you overlay tax on top of it. I really struggle when tax seems to drive commercial outcomes. But if you start with the base of your commercial reality of your group and you go, well, this is what would have happened, now let's apply tax on top of that, I get a lot more comfort. That's a lot lower on my risk, because all of a sudden we're talking about the real world. And once we're in the real world and not the that creative international tax partner transfer pricing lab that a lot of historic instruments were born from, that's already for me a reduction of risk, right? So you're coming and discussing these transactions with me from a real world perspective. I'm already a lot more comfortable than if there's no sort of proxy or no sort of reference point to the market in terms of what you've done. So again, I don't want to be deliberately frustrating in terms of how of these answers. This is designed to help you understand our thinking, and our thinking will go towards, well, what does your group do? I accept that the fact that it's large and capital intensive may mean that certain things might have changed if that's what would happen if your group would have done it. Some groups are strong enough where they go, well, why would we wear that extra cost when we can, when we're happy to have a reduced one? We can do it XYZ way, as opposed to we have options realistically available to us that give us a cheaper outcome than that. Why would we go down a more expensive path? Or your group might be one that says, well, we actually don't have any options. We have to go down this particular path. The realities of your business is what's going to drive the tax outcomes. The tax outcomes aren't going to drive the reality of your borrowing. That's kind of one of the main things I wanted to come across today. So I'll pause from there. Yes?
A question on the private equity scenario, on scenario 5. The question was, what if you have transfer pricing documentation to justify the rate that was actually used on the MRPS?
Sure.
Managed redeemable preference shares.
So now I'll make an assumption. I'll go through two scenarios. So one is this documentation is a little bit legacy. So this was entered into a few years ago. Now the reality is, based on my experience dealing with or reviewing transfer pricing documentations, and believe me, I've seen more than I would ever want to ever again. I started off preparing it and I thought I got sick of it then. Then I jumped to this side and even more sick of them. But the legacy ones are ones that tend to be a few years old. They accept, so let me take a step back. My entire role, people see transfer pricing as a question of credit rating and pricing at the end. That's how they see debt pricing, debt financing. I've been in charge of the finance cluster for about 3 years now, since it sort of formed, or co-in charge or in charge. I have yet to look at or try to apply a credit rating methodology or have a look at Bloomberg, Loan Connector, or any database to try to come up with a price. For me, the credit rating methodology and the price are outputs. What I care about is what goes into these models. What goes into this the credit rating is just a model, right? You put inputs in. It's not discriminatory. You put good information in, good out, junk in, junk out. My job and what my focus has been, because 99% of the issue tends to be here, is to make sure the inputs that go into these models are correct. If I'm comfortable that the inputs are correct, then the outputs are a lot lower risk, and I'm happy for someone else in the office to deal with that. That's not where my value add comes in. What I find is that the historic transfer pricing documentation accepts the inputs as fact and given, and then we'll apply them into those credit rating models and then the pricing models. That I would say probably wouldn't give me a lot of comfort if that was put in front of me. Some of the newer documentation, especially that's come along post-Chevron, actually have a level of analysis which have a look at what would the arm's length conditions have been. So not accepting what's in front of me, but what might we expect to have been there at arm's length. And they provide evidence as to what those conditions would have been at arm's length, and then they go into, well, now that we're comfortable about those conditions, let's put them through the model. Now, that documentation, I get a lot more comfort, and if you have that, great. I'm happy to have a read of it, and if it goes down that model of substantiating what's there in the first place, and then putting it through the models, I'm a lot more comfortable than the legacy ones, which say, well, we're accepting what's in front of us, and we're just going to put it through a model. That's not a lot of value. There's no critical thought behind it. My job is to apply that critical thought to that process. So I'm not, it's going to sound strange, I'm not particularly interested in the credit rating analysis and the benchmarking analysis. All of my focus is on the part that comes before that. Like I said, in 3 years of dedicating my time mostly to looking at financing, I spent all of my time on that, and all of the large cases have focused on that, not on the outputs on the other side. So it might sound strange to say from a debt pricing perspective, but that's the reality.
Thanks.
So what's coming up next? What can we expect from the ATO? There's a whole bunch of guidance coming out, and it's going to be an interesting year for guidance, especially in relation to financing. So the PCG came out late last year, it was finalised. The next couple of cabs off the rank, and I know the second one's of particular interest, is guidance on related party derivatives and interest-free loans. So where they're at is related party derivatives is currently with our senior sort of stakeholders for their final sort of sign-off. It's already gone through a confidential consultation phase, so it's very well advanced. We just need that final approval, and then we'll head towards issuing it in draft and having it out to the market. Interest-free loans, I had my final review of the document last week, so we're just putting some final changes through. We'll get that out and circulate internally for final approval this week. So hopefully in the next couple of weeks that'll be out. So that'll provide some practical guidance. There's a TD that also comes out. There's TD and practical guidance at the same time. So the tax determinations is a very simple document that says, well, if your arms and conditions say X, then it's okay. If they say Y, it's not okay. And then the practical guidance will hopefully give you some guidance in terms of, well, how do you determine whether or not X or Y is the right answer. Other guidance, last year I would have come and discussed guarantee fees with you and the fact that we were intending on providing guidance. We still are in a sense, but we were initially just intending on providing practical guidance to the market, so not the interpretive piece. Now what we've done since then, we've thought, well, best for us to take a step back and consider, well, what is the Commissioner's view overall on guarantee fees, and let's get that out to the market. So that's the work we've been doing in the interim. Is we worked with our colleagues in terms of in RDR, so Review and Dispute Resolutions, and Tax Council Network, to say what is the Commissioner's view overall on this, so we can come up with a holistic view, a final view in terms of to the taxpayers as to what our position on guarantee fees are. So it's all well and good getting some practical advice from one line, but that final interpretive piece I think is what the market really wants on this, so that's what we're trying to help develop. That's underway. We are having sort of those late discussions as to what that final view will look like, and as soon as we have that down, I'll be able to communicate it out. So as soon as I again, as an agent of the Commissioner, I have to respect that there's one Commissioner with one view. My opinion on it, while I head up this area for our business line, I don't have the final say on the Commissioner's view. We need to go through a process. So I'm just a delegated authority from the Commissioner, so once he has his view, then I'll be able to sort of communicate that. I also wanted to stress, and again, apologies for the Z, it really frustrates me, autocorrect on our things. If you can change it to Australian English as much as you want, it'll still autocorrect it to Z. We've talked, and a lot of my focus probably over the last 18 months has been about the price of related party debt. And it's a really important point. But price is only one component to determining an interest deduction. So the rate is one part, the other part is a quantum. And so what my focus, well, continuing the focus on the pricing, but my renewed sort of focus will be on ensuring that we have assurance regarding the quantum of debt. So there will be a number of guidance products in relation to thin capitalisation rules. So that will touch on both safe harbour, but also the arm's length debt test and other components of thin capitalisation. So we've made some really, from a Commissioner's perspective, we've made some really good grounds in terms of the rate applied to related party debt. Now the question is, can we get comfort regarding the quantum of related party debt? So how do we get assurance on both components of an interest deduction? So that'll be our focus sort of in the next year. So I wanted to sort of raise awareness. If you go to our website in terms of upcoming guidance, you'll see a list of all the various items which are coming out in terms of both from a pricing but also from a thin capitalisation perspective.
We've got about 5 minutes for a few questions from the audience. If they'd like to raise their hand and kick off. Can I break the ice then, Shaz? Yeah.
Please.
What was interesting to me in hearing you talk in other presentations is the fact that you've socialised this PCG with other revenue authorities around the world. How did that go? How was this PCG received?
Sure. And again, it's probably very important to know that, or to remember that the PCG is about how we assess a risk, as opposed to necessarily our view on how our transfer pricing provisions will always operate. So in that sense, the heat in the document was already taken off our discussion with our revenue partners. Having said that, I've even just this year, I've just had discussions with a couple of our major treaty partners, including the HMRC, in terms of what's our overall approach on debt pricing. And I must say that they were sort of nodding their heads and say, yep, that's kind of how we see things as well. I think there's a couple of things in terms of our treaty partners. One is we are at least still trying to keep it within the confines of the arm's length principles. You'll probably see a lot of jurisdictions heading towards the OECD and EBITDA sort of cap level on interest deduction. So we're probably going to be seen as really generous in terms of our approach in a few years relative to some of the other approaches which cap interest expense as a percentage of EBITDA. So there's going to be a lot of disputes sort of between nations, I think, in terms of what's the answer on interest deduction. So they're probably having less concerns with our approach because it at least has a framework around the arm's length principle, even though some may not agree with some of the inputs, but it's based on that. It's where there's a mismatch between arm's length principle and interest capping measures that's probably where the biggest divergence is going to be in terms of double tax potential.
Yeah. Any other questions?
There was a question I should raise in terms of, and again, I'll stress it from risk. I talk a lot about inbound because that's the majority of debt. What about outbound interest-bearing loans? What's our approach? I will not ever say from a risk perspective that there should be a different principle applying inbound and outbound. So again, you're part of a group. The question is still how would that borrower or your subsidiary or sister company, whatever it might be, how would they go about borrow? So again, from a risk perspective, and I'm not concluding on our principle of the law, if you lend out at your overall cost of funds, whatever that base is, the only adjustment we ask for is the difference in sovereign risk. And that's not being inconsistent. Australia happens to be a AAA rated nation, so anyone lending into us will be at least equivalent sovereign risk, or if not improving on sovereign risk. But when we go out, the reality is that if you're in a A-rated country, we're AAA, you can't be rated. No company can be rated higher than A. Like it's just the government's that risky, and therefore anyone within that jurisdiction is at least that risky. And so there's a natural added element if you're in a country with higher sovereign risk. We just ask for, that's the only adjustment we require. So cost of funds is absolutely right, but the reality is even if they were to go out and borrow within that jurisdiction, that's probably the outcome they're going to get, is that they'll have to pay that sovereign risk premium anyway.
And that's useful because that was certainly one of the questions raised
yes.
Earlier on. So that's useful to context as well. Yeah.
The sovereign risk element?
Yeah, if you had an adjustment for that,
yep.
you get smashed if you had an audit, a tax office audit overseas.
So this isn't including any premium for, because historically there's always been that premium in terms of credit rating gone overseas as well, in recognition of them being an orphan and away from the group. So that I'm not asking for any of that premium. That can be put away. You can have the same premium as you as a Aussie head company has in terms of your overall margins with your debt. That you can apply on. It's just that sovereign risk. And it generally doesn't tend to be as much as the potential credit risk premium.
What I'm saying is in your transfer pricing documentation, if you articulated sovereign risk in there, in a lot of jurisdictions that almost could almost be viewed as being offensive. They may take offence to that sort of language.
Sure. If it's a language they find,
not the language,
absolutely.
But just, I mean, obviously there's Standard & Poor's and Moody's credit ratings, and it's pretty self-evident. You'd have that all in the documentation. But I think I can see that being.
This is just from a risk perspective. So if you want to get to that same outcome using a different approach, our risk lens will just look at that. Are you just getting that sovereign risk? If you want to say is a different approach that gets you a similar answer, again, I'm not saying the right transfer pricing outcome is that. If you get to the same outcome from a different way, practically what do I probably wouldn't care that much. If you get the low risk answer one way or another way, you're still at a low risk answer.
Yeah.
So that's how I would analyze your risk. If you happen to go about a different path to get that, I'm not concluding on whether it's the right path. I'm just concluding on what our risk lens would be to that.
Yeah. So for the avoidance of doubt and for the benefit of our viewers on the web, the statement is that an outbound loan should really carry a sort of a country sovereign risk differentiator
Correct.
embedded into that pricing.
Correct. Yeah.
Yeah.
Yeah. From a risk lens, I should.
Yeah. From a risk lens.
Yeah.
Yeah.
So I'm talking about risk. We would probably have the same view from our perspective on the audit as well. That if you're going down to a country which is, double B rated, that there is a additional risk of investing in that country. So we'd probably have that same opinion on audit, but from a risk lens, if you go two different ways but you get to that same outcome, I'm not going to. Yeah.
Yeah.
I'm just saying, particularly a WA perspective. Like
Yes, of course. There's a lot of outbound.
So it's more
yes.
relevant here. That's just something
absolutely.
that's come up, and is it an alternative way to broach it?
Absolutely.
Yeah.
So if our teams come and say, well, you haven't done it this way, if you can give them that equivalent analysis, say, well, it would be low risk under yours because we've effectively priced it, I'll let them know that we're comfortable with that.
Yeah. Okay, and then with that, then it's just my pleasure to thank you, Shaz, for your presentation. Extremely thorough, commercially orientated. What I do take away from it, though, is be prepared to justify your commercial circumstances, no matter what they might be, in terms of pricing a loan. So, yeah, before coming to you. So,
Thank you.
and just a vote of thanks and a round of applause for Shaz. Thank you.
Thank you very much.